So now that we've reviewed the basics of accounting for bad debt, we're going to look on this one specific type, and that is using the allowance method, which, as you recall, is a balance sheet focus. And we're looking at the aging of accounts receivable. So what is bad debt? Just to review, you have the option of using the direct write-off method or the allowance method. Now, technically, the direct write-off method is not GAAP. It does not follow the matching principle, which is why it's considered not GAAP, although it is allowed if the amounts are not material, and write-offs are very infrequent. Otherwise, it is required by GAAP, and there are two methods, the income statement approach and the balance sheet approach. Actually, two different ways to calculate the number using the balance sheet approach, but it's how does a company choose which one? It just depends. Some companies feel the profit and loss statement or the income statement is the most important financial statement, and other companies feel that valuation of assets is more important, so they focus more on using one of the balance sheet methods. In this video, we'll review the aging of receivable. Instead of the entire amount and one percentage as is done in the percentage of receivable, the aging of receivable is going to break it out by how delinquent the accounts are. Now again, this is a balance sheet approach. It's concerned with the age of its outstanding balances, and as with any of those methods used for the allowance method, it is an estimate. It may not be exact, but that's okay. Your focus here is valuing your assets correctly or your receivable correctly. And that is called the net realizable value of accounts receivable, which, if you're concerned that some of your customers will never pay you, that will decrease the amount of accounts receivable or value it at a lower amount. And this is performed at the end of the year. So the aging of receivable is a two-step calculation. First, let's look at a T account, allowance for uncollectible accounts. This is a contra asset to accounts receivable. It is a permanent account, so it will have a beginning balance. Write-offs will decrease the allowance account because this is what it's used for. Bad debt expense is what increases the allowance account. And of course, if it has a beginning balance and it's a permanent account, it will have an ending balance also. And it's a two-step calculation because first thing you do is calculate what that ending balance will be. And this is why it's called a balance sheet focus, because I'm more concerned with the valuation or what that ending balance is. But that ending balance is not bad debt expense. You then back into bad debt expense as step number 2. But when we're thinking about an aging method, we want to think about how delinquent those individual accounts are. And as you see with this example, if anything is 1 month out, the probability you are applying is that 5% of those sales will not be collected. For those that are 2 months out or 2 months delinquent, the probability is increasing to 8% with your estimate. And of course, 3 months or 3 months and older, as you can see, the probability gets higher and higher the older it gets, which is why this is thought to be the one method that most follows GAAP. Now, of course, you will have a beginning balance with accounts receivable. So we're going to look at this example using these numbers. You have a beginning balance, credit sales, cash collections, write-offs. You don't know your ending balance, but certainly you could solve for it. And then you're also given a beginning balance for the allowance account. And the ending allowance balance of receivable is what is going to be based on time outstanding. That's how you're going to break it out. So what is your first step? Let's look at the beginning balances, and we will put them in the T accounts. Now back to our example. Now we're going to look at credit sales. So where would that go? What happens with credit sales? It's going to increase my accounts receivable, so we're going to plug that number. And this is what the journal entry would be. Your accounts receivable increases. Cash collections. What does that do to accounts receivable? Well, it's going to decrease it. When your customers pay you, they're paying down that receivable account. So we're going to plug that number. And of course, this is what the journal entry would look like. And write-offs. Write-offs are done with a debit to the allowance account and a credit to the accounts receivable, not bad debt expense. This is using the allowance method. This is what this allowance account was created for. So tell me, which is the incorrect journal entry? Is it the allowance for uncollectible accounts and accounts receivable, or would I record bad debt expense and accounts receivable? And of course, the first method, A, that's how your journal entry should look, using the allowance method. As you can see, the one below, that is incorrect for this scenario, but it would have been correct had you been using the direct write-off method. Bad debt expense using the allowance method will be an adjusting journal entry at the end of the year. You never record bad debt expense for the actual write-off when you're using the allowance method. So now we need to calculate the ending balance, which is $240,000. Plug your number. But you're not going to just use $240,000 and multiply it by a percentage. That is just the total percentage of the receivables method. This has to break it down more, so you could even call this a three-step. First, you've got to break out how delinquent some of those accounts are. And bad debt expense will be the plug number, again, using this method. So, looking at these various numbers, total $240,000, but $114,000 of that $240,000 is relatively current, and that's of that amount you multiply that by the 5%. So of that $114,000, you believe $5,700 will be uncollectible. The 2 months out, $83,000, you multiply that by your estimate of what will be uncollectible, 8%. Same for 3 months out and 91 days and older, which you believe will be the probability of collecting is only 50%. So you end up with a total number that you want for your ending balance of the allowance account. Now, had you been using just the straight percentage of receivables, you would have taken that 240, multiplied it by the 10%, and the ending balance you would have used is 24,000. But with the aging method, it's a little less than that. And this is why it's actually felt to be the most accurate. But remember, any of the three methods, the percentage of sales, the percentage of receivables, or the aging of receivables, these are all estimates. Management's estimates of what they feel they may have to write off in the future. It's usually based on past experience, and of course economic conditions can play into that. Now, this 23,920, this is not bad debt expense. This is how you're valuing your receivable, your net realizable value on your balance sheet. So then you still have to back into what bad debt expense is in order to get to that number. And that would be $22,420 in this example. Here is your journal entry at the end of the year. You're recording bad debt expense in the same period, the same accounting period as the sales occurred that you think eventually may be uncollectible. That's why it follows the matching principle. And here's your balance sheet presentation. Accounts receivable less that allowance using the aging method, 23,920, to give you a net accounts receivable, or your net realizable value, of $216,080. And a review of the T accounts and how we came about the numbers. And that is the aging of accounts receivable method.